Michelle from Freelance World here. Today we're basically going to be talking about dividends for limited company directors and shareholders. It's a question we get asked about a lot, so I hope this is of value to you. So basically a dividend is when you have money coming into the company, you have deductions to be taken from that. So that includes your salary and your expenses, so allowable business expenses come off of that money. What you then have to do is pay corporation tax on the profit that's left. So that's 20% of all profit up to £300,000. So anything more than £300,000 we would discuss with you on a case-by-case basis. So if you do have any questions about those, feel free to give us a ring and we'll chat through that with you. Once you've paid your corporation tax, which is 20% up to the £300,000 profit, you can then take a dividend. Basically, anybody who is a shareholder in a limited company can take a dividend out of a limited company. That could be the director, the second shareholder, who might be the husband or wife, and in some cases a third or fourth shareholder. Basically, the important thing to remember is that the dividend has to be taken in proportion to the amount of shares that you have. So for example, if you have a company that has got shareholders, one who has got 60% shareholding of the company and one who's got 40% shareholding of the company, they would get 60% of the dividend and 40% of the dividend. It's pro-rated. So what are the advantages of dividends? Basically, the advantages of dividends are that they are more tax efficient because you don't have to pay national insurance contributions, employee national insurance contributions. That's an important thing to remember. However, it will be seen as part of your income along with your salary, so therefore it will be declared on your personal tax return, which is the return that monitors from April to April. So how much personal tax will you need to pay on a dividend? Basically, you will be declaring this dividend on your personal tax return, and as such there will be a deemed 10% on it. What the main thing to remember about your dividend in that case is that if you think you're taking a £10,000 dividend, you actually should be adding 10% on that, as that's how it will show up on the tax calculations. So bearing in mind all the time, 10% is the deemed amount. And the other thing to remember is that this 10% is only if you're below the higher rate tax band, and no further tax will be payable on that dividend other than the 10% until you reach the higher rate tax band, and the higher rate tax band is £42,000, £475. So anything above that, again, ask us and we'll be more than happy to advise you.